As a reminder, the content shared on this podcast is intended for informational and educational purposes only. It does not constitute personalized financial advice. For guidance tailored to your specific situation, you can schedule an appointment with Carol. This is an independent podcast not affiliated with Money Concepts Capital Corporation. Welcome to She Wins: Women, Wealth, Wisdom, and Legacy, the podcast where financial empowerment meets fearless living. If you're a woman who's built a life with purpose and is ready to align your wealth with what matters most, you're in the right place. Your host, Carol Eddy, is a certified financial planner, financial educator, and passionate advocate for helping women live fearlessly and leave a legacy. Whether they are preparing for retirement, managing an inheritance, or simply looking for trustworthy financial guidance, Carol has helped her clients feel confident in their financial plan for over 25 years. Each week, she'll share insights and practical strategies to help you create financial freedom, navigate smart money choices, master your money mindset, and make winning decisions now and for the next chapter of your life. No intimidation, no overwhelm, no jargon, just wisdom, clarity, and the confidence to manage your wealth, embrace your power, and craft a future you love. Welcome to the show.
Hi, and welcome back. I'm your host, Carol Eddy. Imagine opening your mail in retirement and finding a tax bill you didn't expect. You thought you'd done everything right, but the IRS had other plans. Today, we're uncovering how to stop surprises like that, not just with withdrawals, but with strategies that protect your income, your giving, and your legacy. In our last episode, we peeled back the curtain on one of retirement's biggest surprises, the hidden tax traps of withdrawals. Where you pull your money from and when you pull it can quietly shrink your nest egg without you even realizing it. I heard from some of you after that episode. Some said, I didn't know Social Security could be taxed like that. And others said, I thought I was done with surprises when I stopped working, but now I see retirement is full of hidden traps. And that's exactly right. Retirement is like driving down the highway. You've got your destination in mind, enjoying your freedom, traveling, spoiling your grandkids, giving back to your community. But along that highway, there are toll booths. And if you don't see them coming, you may get stuck paying more than you should. Withdrawal strategy is about spotting the first toll booth. But here's the truth. There are many more ahead. And if you only focus on withdrawals, you may miss some of the biggest levers for protecting your wealth, supporting your values, and leaving a legacy. Let me tell you about a couple we'll call Martin and Diana. They did everything right. They worked hard, they saved faithfully, and retired comfortably. They sat with their advisor, built a withdrawal plan, and avoided the traps we talked about last time. No surprise taxes, no Medicare surcharges. They felt safe. Then one day, their attorney said, what happens when you're gone? What happens with your estate? Do you want your children and grandchildren to receive this wealth? Martin and Diane realized they had only been looking at half the picture. That's what today's episode is about, taxes and retirement beyond the withdrawals. We'll explore 3 powerful strategies: Roth conversions and how paying some tax now can create freedom later; charitable strategies, how giving smart can reduce taxes while increasing joy; estate and legacy planning. This would include the latest updates on estate tax law and why planning still matters. My goal is to help you move from fear to confidence, from confusion to clarity, and from surviving retirement to designing a legacy. So let's dive in. Part 1. Seeing the bigger picture. When most people think about retirement taxes, they zoom in on one question: how do I take money out without paying too much? It's a good question, but it's not the only one. Think of your retirement like building a house. Withdrawals are like your monthly utility bills: electricity, water, internet. You have to pay attention, but they're not the whole story. What about the design of the house itself? The strength of the foundation, the shape of the roof, the layout of the rooms. That's what Roth conversions, charitable giving, and estate planning are. They don't just manage today's bills, they shape the whole structure of your financial life. If you only focus on withdrawals, you're managing the bills but ignoring the blueprint. So let's start with the first big piece of that blueprint: Roth conversions. Let's face it, No one likes paying taxes, but sometimes choosing to pay taxes at the right time can save you and your loved ones an enormous amount later. That's what a Roth conversion is. You move money from a traditional IRA or 401k into a Roth IRA. This means you pay the tax today, but from that moment on, the Roth grows tax-free. No more taxes on withdrawals. And when your kids inherit it, they receive it tax-free also. Julie's story. Julie retired at age 62. She was single, healthy, and had built a nice nest egg in her 401k and her IRA. She lived mostly on cash savings and a small pension, so her income was modest. Instead of letting her IRA sit untouched until 73, when RMDs would force withdrawals, she started converting $50,000 each year into a Roth. Yes, she paid taxes on those conversions, but she stayed in a comfortable tax bracket. By 73, she had shifted nearly $500,000 into Roth accounts. Years later, when her children inherited, they received the Roth accounts tax-free. Julie's choice saved her family more than $300,000 in taxes. And just as importantly, Julie had peace of mind. She knew her kids wouldn't face a messy tax bill after she was gone. Paul's story is the contrast. So Paul is her neighbor. Paul decided to do nothing. He left his IRA alone. At 73, RMDs kicked in. These were large. Those withdrawals pushed him into a higher bracket, triggered IRMA surcharges. That's something we talked about in our last episode. And that also raised his Medicare premiums. And when his children inherited, they had to drain the account in 10 years to pay big taxes. Paul didn't save by waiting. He lost opportunities. Here's how I'll explain it. Think of your money in the three buckets. Taxable accounts you have already paid tax on, like brokerage accounts. Tax deferred accounts you haven't paid tax on yet, like IRAs and 401ks. And then there's tax-free, where Roth accounts lie. Most retirees have a big tax-deferred bucket and a very small tax-free bucket. The goal is to gradually pour water from the tax-deferred bucket into the tax-free bucket without spilling over into higher taxes. Timing matters. So when is the best time to do conversions? Often it's the gap years, after you retire, but before RMDs begin at age 73. You may even want to start them earlier, depending on your situation. But anyway, maybe if you haven't started Social Security yet, your income is lower, which means your tax bracket is lower. Those years are golden for Roth conversions. Here's Ellen and Mark's story. They retired at age 65. For the next 8 years, they lived on cash and a pension. Each year, they converted $40,000 from their IRAs into Roths. By age 73, they had $400,000 in Roth accounts. Their RMDs were smaller, their Medicare costs stayed lower, and their kids inherited with fewer strings attached. Now back to IRMA. In case you missed what we talked about last time, one caution in converting too much can tip you into a higher Medicare premium, and it's called IRMA, the Income-Related Monthly Adjustment Amount. All it's saying is you may pay more based on your income. For example, if a married couple's income jumps $1 over the threshold, they could pay hundreds more per month in Medicare premiums. That's why planning conversions year by year is critical. Then there's the widow's window. Here's another scenario I see often. A couple does all their planning together, then one spouse passes away. Suddenly, the survivor files as a single taxpayer with smaller brackets. Those are tax brackets. That means more income is taxed at higher rates. Doing Roth conversions while both spouses are alive can be a gift to the survivor. The bottom line is, Roth conversions aren't about being clever. They're about being intentional. They're about freedom. The freedom to use your money without fear of future tax hikes, the freedom to give generously without triggering penalties, and the freedom to leave a legacy that isn't tangled up in IRS paperwork. Part 3, Charitable Strategies. Giving smart and giving joyfully. Now let's move on to something that lights up so many women I work with, generosity. You've worked hard, you've saved, and many of you, giving back is part of your purpose. But here's the thing, the way you give can make a huge difference in your taxes. Evelyn's story. Evelyn was 72. Every year she gave $10,000 to her church. She would withdraw from her IRA, pay the tax, and then write a check. But because she didn't itemize, she wasn't really getting a deduction. And then she learned about qualified charitable distributions, or QDCs. At age 70, you can give directly from your IRA to a charity. The money never shows up as taxable income. And if you're over 73, it counts towards your RMD. Evelyn started sending her $10,000 directly from her IRA to her church. That lowered her taxable income by $10,000, kept her Medicare premiums down, and still supported her cause. Same gift, smarter path. Then there's donor advised funds. This is another powerful tool, and it's called donor advised fund, or a DAF. Let's say you sell a business or you sell stock with big gains. That year, your income spikes. You can contribute a large amount to a donor advised fund, get the deduction right away, and then spread out your giving over future years. It's like creating your own charitable foundation without the complexity. One couple I worked with sold a rental property. They put $100,000 into a DAF that year. That cut their tax bill significantly, and now each year they recommend grants to their favorite charities from the fund. And then there's appreciated stock. Don't forget, you can also give that appreciated stock. So instead of selling the stock, paying the capital gains, and then donating cash, you donate the stock directly. The charity sells it tax-free. You avoid the capital gains and still get a deduction. Head, heart, and hands. I tell my clients, give with your head, your heart, and your hands. The head, give in tax smart ways. Use qualified charitable distributions and donor advised funds or stock gifts. Heart, give to what matters to you, your church, your school, your community, etc. Hands, see the impact. Volunteer, connect, and witness the change your giving creates. Charitable strategies let you multiply impact. You help others, you reduce your tax bill, and you experience more joy. Estate and legacy planning, the long view. Now let's turn to a third lever, estate and legacy planning. For years, people worried about the 2026 sunset when the estate tax exemption was set to drop in half. That caused panic gifting and rushed decisions. But in 2025, Congress passed the One Big Beautiful Bill. That law permanently locked in higher exemptions. Starting in 2026, each person has a $15 million exemption indexed for inflation. That's $30 million for a married couple. So that cliff is gone, but it doesn't mean you can't ignore estate planning. Robert and Linda's story. Robert and Linda had a $12 million estate. Under the old rules, they worried they'd face estate tax in 2026. They rushed to make big gifts. Now with the new law, they're in the clear for future federal estate tax, but they still created trusts to protect their wealth, guide how their kids would use it, and include charitable gifts. Because estate planning isn't just about how much your heirs get, it's about how they receive it. Beyond taxes. Do your heirs get money all at once or in stages? Is it protected from creditors or divorce? Does it carry your values or just numbers? Even if your estate is well under the exemption, you still may want to avoid probate, simplify transfers, and create clarity for your loved ones. I've seen families torn apart, not by the size of the inheritance, but by the lack of clarity around it. The permanent myth. And remember, permanent in tax law doesn't always mean forever. Laws change, presidents change, Congress changes, and that's why estate plans need regular updates. There are 3 scenarios for estate planning. Under $500 million, you want to focus on possibly avoiding probate, keeping documents current, and clarifying your wishes. Between $5 and $15 million, you may not face federal estate tax, but state estate taxes. Gifting strategies and trusts are worth reviewing. And if you have over $15 million, you need advanced planning, trust, family partnerships, charitable vehicles to minimize future tax exposure. Estate planning is not just for the ultra-wealthy, it's for anyone who wants peace, clarity, and legacy. Part 5, pulling it all together. So let's bring it all together. We have 3 levers beyond withdrawals: Roth conversions, which is paying some tax now to free yourself later. Charitable strategies, giving smarter with joy and tax savings. And estate and legacy planning, shaping not just what you pass on, but how you pass it. These aren't one-time decisions. They're strategies you revisit year after year, adapting as life and laws change. And you don't have to do everything at once. Start with one. Run the numbers on a Roth conversion. Explore whether a qualified charitable distributions make sense. Review your estate plan. Each step builds clarity. Each step builds confidence. Each step strengthens your legacy. Here's the big idea. Withdrawals are important, but they're only half the puzzle. The other half is bigger. It's about designing your retirement and your legacy. Roth conversions, charitable strategies, estate planning, together they move you from reactive to proactive, from confusion to clarity, and from fear to peace. I want you to feel empowered, to see taxes not as a burden, but as an opportunity to align your money with your values. That's why I created a brand new resource for you, the Retirement Tax Strategy Checklist, Beyond Withdrawals. It's one page, simple, and it pulls everything we've talked about today into clear steps. Download it for free in the show notes. And if you found today's episode helpful, would you share it with a friend? When women share wisdom, we change lives. Not just our own, but our families, our communities, and generations to come. You've worked hard to build your wealth. Now let's make sure it works just as hard for you and for the people and causes you love. Thanks for listening.
Thank you for joining us today for the She Wins Women, Wealth, Wisdom, and Legacy podcast. If today's episode sparked a shift in how you think about your money, your future, or your legacy, imagine what's possible when we walk this journey together. And if you found value in today's conversation, please share this episode with a woman you care about. Together we rise and we shine. If this inspired you to take charge of your financial future, don't stop there. Download your free guide, A Woman's Guide to Triumph in Every Decade of Her Wealth, by clicking the link on the screen or in the show notes. It's designed to give you powerful tools and clarity at every stage of your wealth journey. And be sure to follow or subscribe now so you never miss an episode. Until next time, stay wise, stay empowered, and remember, it's time to rise, lead, and thrive with your wealth, your wisdom, and your legacy. As a reminder, the content shared on this podcast is intended for informational and educational purposes only. It does not constitute personalized financial advice. For guidance tailored to your specific situation, you can schedule an appointment with Carol. This is an independent podcast not affiliated with Money Concepts Capital Corporation.